guys, welcome to another video where I'm going to show you a trade that I took myself personally and I shared in my group beforehand with the entry, the exit, the reasons, and in this video I'm going to go a little bit in deep with the model that I personally is one of my favorites models because it's very easy to see once you start spotting that model, and almost not all but almost any trade idea can be framed in that model that's called the market maker. And I know there is many people talking about this model, many people with explaining how they trade it, and I'll just show you the way I see it personally, and in my opinion is the easiest. Like, if you want to know the basics, I would recommend you watch any other video or the typical picture of the market maker model where there is original consolidation, distribution, accumulation, reaccumulation, reversal, to learn the basics if you are not understanding what I'm saying. But I will try and make it as easy as possible and put sense in it. Especially, let me start with the little bit high time frame. Last week I was one of the few people that were bullish. Most of the traders that, at least in the community that I move, were bearish, and my reason was very simple. As I explained in the first video, market structure, we are coming lower, okay, lower low, lower high, another lower low, and then this broke structure. This was giving the first clue that we're changing structure, and then here we had the higher low confirmed, and then a new higher high extra confirmed. So after this was last week's price action, I was completely bullish. Why? Because of all this confirmation. So price can come down, okay, price can do whatever it wants in this area between this high and this low. That's called external liquidity, that famous ERL, external liquidity. It's this. So it can do anything it wants unless it doesn't sweep below this, or, well, if it sweeps below high, we're going higher. That's obvious. So it shouldn't break this low. So this was the higher low I had marked, and I remember price coming on Wednesday all the way low till here, okay, and I was still bullish. I still said I'm bullish. Why? Because my higher low was intact, okay. And now I'll zoom in this price action. You will see the logic behind this. And after that, on Thursday, well, Wednesday as well, and then Thursday, Friday, finally, I remember Friday was NFP. It blasted to this high and made a new higher high, okay. So this was the price action. Now the interesting thing of this is this over here, this price action here. We had this equal lows resting over here, very clean, right? Let's mark it like sell side liquidity, and then this does the low that pierced below the sell side liquidity. Why? Well, this is the famous internal liquidity. If this is external, this high and this low is external, this lows here, all between those two external is internal, and this is the extreme internal, sorry. There's no more liquidity after this. So it took that liquidity and plus something that I noticed quite late, but it was there, a tiny 4 hours fair value gap right there. Look at the precision. That's the reason I like ICT concepts. So now if I remove all this, we can see how cleanly it comes below, takes the external, the internal, and then it fills up this fair value gap, the last one in the 4 hours range, and blast to the upside. So after this, my bias was totally bullish, just buy, okay. So what happens once we take and we make a new higher high? We expect a retracement back to discount, and the same story repeats, right? Now for exchange, this here low is our external liquidity low, and this is our external high. I'm still bullish, right? Because we are going back to balance the weekly range. So until we don't arrive till the weekly premium range, I am still bullish. Unless this changes, of course, we always adapt. So now we have these two external ranges. This is the discount, And all this below, for example this low here, that's quite obvious, can be sell side liquidity, internal range. Okay, we have fair value gaps as well here. So this is what I'm expecting, anticipating. Okay, price can come all the way low here and it can do what it wants between these two ranges, right? This would be the last higher low that's protecting our bullish movement. So now let's see how I captured the trade. That was a market maker sell model on Tuesday. Let's scale down. So right here we were at the open of London 3 a.m. This candle here closed right at 3 a.m. and left this fair value gap that was in my eyes, this one here, and it created that fair value gap. So once this was made, my expectation was price to retrace back to the fair value gap and then come lower. So in this movement I want to see the market maker sell model and frame the idea. So we have the fair value gap plus this over here, the low of this candle, it's a order block right here. That's the order block, this is the fair value gap. So price can retrace to one of these two PD arrays because this is like the last swing. This high here, we would have lower low, lower high, and then lower low. So after this I just scale down. 15 minutes supports idea. 15 minutes has a tiny fair value gap here that doesn't have to be fulfilled necessarily, but it's there. And for sake of simplicity, we'll just mark it. Okay, and then this is a fair value gap. This is an order block, 15-minute order block, but I like to take the two candles. That would be like the 1 hour order block. It's the same, more or less same thing, and etc. etc. So after this, we can put our range. Right, we want to sell above 50%. So we let price do its thing. Let it come above 50% and then look for our model. Okay, right there is on the 50%. Let's play it out. Okay, now let me explain. Let's go into the 1 minute. That's where I took the trade and it's more clean, the market maker model. So what do we have now here? We have original consolidation, then we have the buy side of the curve right here. Okay, comes to a PD array, in this case the order block. So in this moment I deleted the fair value gap, because once the above premium array is hit, then the below one, that is simply just a distraction for me in my opinion. So I just delete it because it's hitting the order block. That's what I want to see. And after that we have the reversal and the sell side of the curve. So it goes from buy to sell, market maker model. And right here was my entry. Right here, when this low was broken, let's just put it black. Right here, price came back aggressively after fulfilling the fair value gap of 1 hour and hitting the order block, and it created this tiny fair value gap here. And right here I entered here, my stop was here above, and I targeted this lows, the original consolidation, a 1 to 6, almost 5.9, and price eventually hit the target. Okay, so this was my trade. But many of you will say that this was an entry as well. This price action here, we have our entry pattern. Price comes up, then comes down, and giving a fair value gap, and this could have been a trade. Of course could be a trade, totally valid. We are above premium, we have gone above premium, we have hit the fair value gap. Here was the 1 hour fair value gap, and we have time and I side everything. This was a valid trade. But if a market maker model is creating the buy side of the curve, so it will at least have one type of extension. Like, it won't just go up and then come down. It has to make the buy side of the curve where it's accumulating. Then it has first accumulation, second accumulation. It can be optional. It can have up to 2 or 3 accumulation in my experience that I've seen. So this, I would say, first accumulation, and then this is the second accumulation outside, once it came out outside from the original consolidation. And then here we have the reversal pattern and the distribution. You can see how fast is the distribution compared to the accumulation. Accumulation is more sloppy, like slow, consolidating, and then finally once it distributes, it just blasts towards the target. So you can identify the phases of the market maker in this way. So if you take this trade and you lose, it's not a problem. Losses are part of the game. So you don't have to think that you are a bad trader or you didn't read price action well. It's completely inside your experience or your rules, your trading plan. You can take it and then take a second entry here. In my case, I think I was busy or doing something else and I didn't took this entry, honestly. Or maybe I just didn't like the entry, the price action in that moment, how it was looking. Because with experience you also gain a kind of intuition. Like, it's something you can't explain, you just gain with experience. When you're doing something all the time, Monday to Friday, repetition, routine, you start gaining like an intuition. And this was like something I wouldn't take, or maybe in another day I would take it. But what I mean is, if you lose, it's not a problem. Trust your setup. The setup was not invalid until this swing was taken. That is the leg. So you see, we are inside this leg, and right when the time frame is switching, we can take the trade. And obviously the safest entry would have been after this market structure or this market structure, and you could have entered here. You could have put your stop loss above this, because, or waited for the second distribution, because this continued going lower. As you know, we were bearish. So you see, price continues a little bit more to some other high time frame target. So this could have been a second distribution to scale in. Like, you have this low getting broken right here, and then price coming back to the fair value gap, stop loss above, and target a 1 to 2, 1 to 3, or whatever we have at the left. So basically this is the market maker. If you need to go in deep to understand what are each phases and all that, I can recommend some other people, because there are many experts that just trade this model out of anything. They just do this, and they are much better than me anytime. But this is the way I like to frame it, and I hope you can get the idea of what I mean. Like, we were looking at the 1 hour, and basically if I delete all this, basically we were expecting price to come back to that 1 hour fair value gap and then continue lower. So we're just making like the buy side of the curve the retracement, and the sell side of the curve, I mean the sell side distribution, the impulse move of our trend. Like, we have impulse, retracement, impulse, retracement, impulse. So all these are market maker models. This would be buy side of the curve, sell side of the curve, buy side of the curve, sell side of the curve. And always the buy side, the reversion will happen on a key point, like maybe high time frame fair value gap here, maybe an order block here, and so on. So basically that is the market maker model in my opinion, and that's the reason I say you can frame it almost always. in any trade idea. And when you can, it becomes beautiful. It becomes beautiful because once you start seeing these things, like we start seeing the original consolidation, then we know that this is a clean liquidity pool where price will be attracted to. We know where to expect a reversion, and we get it, so we can get this tiny stop losses. Like this was like the ultimate PRA of the 1 hour. And time is key. When will it reverse? During London, it won't just keep on, well, it can do whatever it wants, but I mean everything was aligning. So this setup was beautiful in my opinion, very, very beautiful. That's all I have, guys, for this video. I don't want to make it very long like the previous one. I hope you get some nice nuggets from this video, and anything, you can contact me in the Telegram. You can get in touch with me and ask me anything you like, and have a healthy forex community to grow together. See you in the next one then.